I'm going to explain private money lending in plain English, what it is, why it works, and how it fits into the natural journey of a real estate investor. And by the end of this video, you'll understand bridge funding, the difference between hard money and private money, our vertical capital stack, and why real estate investors rely on funding like this to grow. First, let me start off with this story. One day, Anitra and I were sitting at this closing office with a title attorney we worked with for years. And out of the blue, he said something that really stuck with me. Y'all just skipped the natural progression of a real estate investor. We looked at him kind of puzzled, like, what do you mean? He explained, most investors start small. They wholesale, they fix and flip, they buy and hold, and they do that for years. And sometimes it could be decades. And then when they're ready to slow down, maybe when it's time to retire, they sell off a piece of their portfolio or their entire portfolio, and then they start lending money. Then he said, but y'all skipped all of that. Y'all went straight to being the bank. And he was right. Now, we didn't skip real estate altogether. Between the both of us, we've been involved in over 300 real estate transactions, buying, selling, fixing, and investing. So we know residential real estate like the back of our hand. But instead of waiting until retirement to become lenders, we decided to step into the role early. Why? Because Anitra and I were just fascinated by how a bank operates. And it's more money being the bank and less stress. But think about it. Banks don't just sell financial products. Their main business is lending money secured by real estate. And we realize private money lending lets us do the same thing. Create a system where money makes money without becoming a giant institution, and to make money on real estate without the hassle of owning it. And that's how our journey into private money lending began. So let's break it down. What exactly is private money lending? At its core, private money lending is when an individual or a small group of people provide loans, usually short-term, backed by real estate. The loans are typically used by investors who need fast access to capital. Instead of going to a bank where the approval process could take months, they turn to private lenders who could underwrite deals quickly and who could close fast. And here's the key, the loan is secured by an asset. At Vertical Capital, we focus on residential real estate, like single-family homes, duplexes, triplexes, and small multifamily properties. That's our bread and butter. The property itself acts as collateral, what makes the loan safer for us as lenders. Why investors use private money? Here's something you need to understand. Real estate investors don't always have the luxury of waiting. Deals have to move fast. Properties get snatched up in days, sometimes hours. If you walk into a traditional bank, the process can take 30, 60, or even 90 days. That just doesn't work for an investor who needs to close quickly. That's why bridge funding and private money are so critical. Bridge funding is exactly what it sounds like, a loan that bridges the gap. It's short-term financing, usually 6 to 12 months, designed to help an investor acquire or rehab a property until they could refinance with a long-term loan. Here's an example. An investor finds a distressed property. They need to buy it fast, renovate it, and then refinance it into a conventional mortgage. Our loan gives them the bridge they need to get from the purchase to the refinance. Why investors don't always use banks? Banks care about credit scores, income verification, tax returns, debt to income ratio, all the paperwork. Private money lenders care primarily about the asset and the exit strategy. If the deal makes sense, we move. Guys, if you like this content, like and subscribe to the channel and help this video get in front of more future lenders. Now, let's clear up some confusion because a lot of people mix up hard money and private money. Hard money lending, this usually comes from companies that are in the business of lending. They're institutionalized. They have set terms, higher fees, and stricter processes. Rates can be steep, points up front, and there are not a lot of flexibility. Private money lending, this is relationship driven. It's often individuals, families, or small groups lending their own capital. Terms can be more flexible, deals can be structured creatively, and the relationship between the lender and the borrower is key. Think of hard money as the corporate version, private money as the boutique version. Both serves a purpose, but private money gives investors and lenders more room to structure deals that benefit both sides. Now that we understand why investors use this private money, and you understand the difference between hard money and private money, now let's cover where you should start. Start with building your capital base. When Anitra and I first started Vertical Capital, we didn't have millions of dollars to lend, so we focused on raising capital. And our capital stack consists of our own money, family and friends, business associates, and community members. We built an online community of people who wanted to learn how to become the bank in their own lives. Some of our members now invest alongside of us, and some of our members are creating their own private money lending business. If you want to join a community of like-minded financiers, click the link in the description to join our free finance community. Today, Vertical Capital manage a $2 million bridge loan portfolio. Our investors pull money from multiple sources: cash, retirement accounts. If they have a brokerage account, they use margin loans, even insurance loans from their cash value. And here's the best part: our investors are 100% passive. We pay them 10% and we handle everything else: finding the deal, underwriting it, servicing, managing the draw process, while they sit back and collect. Step 2, determine the asset you will lend on. Now at Vertical Capital, we lend only on residential real estate right now. In the future, we may add commercial. Why residential? Because it's stable. People always need housing. The market may shift, but the demand for homes never goes away. Since we had already completed 300 residential transactions before our first loan, we knew we could confidently evaluate properties and design a product borrowers needed. When we underwrite a deal, we look at the property ARV, and that's after repair value, the purchase price, the rehab budget, and the exit strategy. Whether the borrower is selling or refinancing, we lend conservatively, using up to 65% of the property's value. We fund up to 80% of the purchase price and 100% of the rehab costs. But we always require our borrowers to bring money to the table. Why? Because it shifts the risk from us to them, ensures they fully committed. In some cases, we will offer 100% financing if the borrower put up additional collateral. Let me give you a few reasons why this business model made sense for us. We mimic the bank. We get to play the role of the lender, earning interest and fees without the regulatory headaches of a bank. We understand the asset. With hundreds of transactions under our belt, we know how to evaluate deals better than most. Helping other investors. We provide capital to people who are out there doing the work, fixing properties, improving neighborhoods, creating housing. It's a win-win. If you're brand new to private money lending, or you're thinking about getting into it, here are some of the basics. Always secure your loan, record a mortgage or deed of trust. Make sure your position is legally documented. Lend conservatively. Stick to safe loan-to-value ratios. Don't let greed push you into risky territory. Evaluate the borrower in the property. Both matter. The best property could still lose money if the borrower can't execute. Know the exit strategy. Every loan needs a clear path for repayment if the borrower flipping, refinancing, or selling. Stay educated. Real estate market shifts. Stay up to date on values, trends, and lending practices. Most investors spend years wholesaling, flipping, and renting before they ever become lenders. And that's fine. There's value in every stage of the journey. But Anitra and I decided to step into the lender role early because we wanted to operate like the bank. We knew residential real estate inside and out, and we saw private money lending as a way to generate income while helping other investors grow. Private money lending isn't just about making money. It's about creating a system where money works for you, secured by real estate, while empowering other investors to build, flip, and own property. And that's why I wanted to break this down for you today. Now I have a question for you. Would you rather spend years grinding through flips and rentals, or would you consider stepping into the lender role sooner like we did? Drop your answer in the comments because I'd love to hear your perspective. And if the answer is yes, join our free finance community. The link is in the description. And if you found this breakdown helpful, hit that like button, subscribe, and share this with someone who's been thinking about investing in real estate or getting into private money lending. Because here's the truth, real estate doesn't always have to follow the traditional progression. Sometimes you can skip straight to being a bank.